Hi, I'm Christopher Garman from Eurasia Group, Director for Emerging Markets. We're a political risk advisory firm. We have offices in London, New York, and Washington. Our job to our clients is to map out and identify how political decision making can impact the business environment, both for financial markets and for the corporate sector. But we absolutely do see a shift in where a political risk is going to flare up over the next 3 to 4 years. If you look at politics and the global geopolitical environment post the 2008-2009 financial crisis, the major concerns of the corporate and financial sector rest squarely within Europe and the United States. The ability to manage the Eurozone crisis and how to manage the dysfunctional politics in Washington. What we see over the next 5 to 6 years is that risk is swinging back towards emerging markets. And a lot of this has to do with the fact that over the past 14 years, a lot of the political leadership in emerging markets went through what we call a political supercycle. When everything was going well economically, it lifted all boats and politicians were inordinately strengthened. Now, they're headed into very choppy waters. They're dealing with lower growth equilibrium, more difficult macroeconomic trade-offs internationally, and tremendous pressures from growing middle classes that want more than just jobs and income. The political challenge and the conundrum that many policymakers face in emerging markets is that they're going to have to deal with the demands that come with economic success. The percentage of the populations which are constituted as middle classes, on average have grown from anywhere from 20-30% of the population to 50-60% of the population. And what these new voters want is beyond just a job. What they want is quality of education for their kids, healthcare services for their families. They can buy things they don't want to get stolen, crime, security. They can buy a car they don't want to get stuck in traffic and dealing with pollution. And so the political dilemma is, how are you going to deliver to all these rising demands that come from a cycle of high growth in a context where your capacity to spend is diminished? And this will probably generate a lot of political tension going forward. Some governments are going to respond constructively, other governments are going to respond very poorly, and we see governance dysfunction also rising. Nowhere is the political challenge of rising middle classes larger than in China. This is going to not only will the Chinese leadership have to deliver on these demands of the existing urban populations, but also to provide services to a tremendous influx of labor from rural areas towards urban areas. And the ability to expand all of these social services in a context where the leadership is rebalancing their economy away from a capital-intensive, export-oriented growth model towards one based on domestic consumption, which will have to come with lower average growth rates in order to be able to pull that off, is going to be a political tightrope which will probably have profound global repercussions. All this in a context where you do not have open competitive elections and you have a closed authoritarian structure in which you have to continue to deliver economic goods to the population. It's not a coincidence, if you look across all the emerging markets, that the sense of urgency for reform is biggest and largest in China than anywhere else. The energy landscape today is radically different than it was just 5 years ago. Today, from a demand of hydrocarbon products and oil, we have muted demand in the United States and in Europe, just because from an economic point of view, we're not going to come back to the same average growth rates that we had prior to the global financial crisis. For many of the reasons that we highlighted of the political challenges in emerging markets, we also don't see policymakers moving in a way that can increase growth potential in a meaningful way. So demand for oil products is diminishing, and the supply is growing given the energy revolution and development of tight oil, shale gas, and also development of oil sands in Canada. We do have non-OPEC oil production rising as well, and most likely in places like Mexico and even Brazil to a certain extent, and difficult oil plays in Russian production. So what this suggests is that we're headed to an environment where oil prices are probably going to have a much stable equilibrium closer to $90 per barrel, which is the level at which some of the more difficult projects are viable economically, and also the level at which the Saudis want to defend in order to be able to use their swing production to defend at $90 per barrel for even domestic economic political purposes. But from a supply perspective, at least over the next 2 years, we're also going to have an influx of more supply in the market, given that the crisis in Iran is probably headed to a resolution and a lifting of sanctions. Given the domestic political justifications and interests in taking the economic hardship out of the current sanctions regimes, and Rouhani does have the green light within the Supreme Leader to do so. And on the United States side, leading the P5+1 negotiations, tremendous interest of Obama to also get a deal before the end of this year. And I think that, at $90 per barrel, the economic viability of the Canadian oil sands remains intact. Obviously, it would be much more problematic for Canadian crude production if in fact we had an environment where oil prices were to go much lower than that. On the U.S. side of the equation, probably the biggest question mark rests on whether or not Keystone XL pipeline will be approved. The politics in Washington has been complicated, and we've had a number of delays, which we didn't always fully anticipate. But our view does remain that after the midterm elections, and after the Supreme Court in Nebraska rules on the feasibility of the alternative route that's been proposed, gets ratified, that the administration will probably approve the pipeline. Even though the demands on the environmental lobby is significant, we are headed towards a very difficult national presidential election, in which the Democrats are going to be keen to stay in the White House. And the jobs mantra with a pipeline deal probably is going to trump the environmental concerns. But evidently this is a difficult political environment in order to be able to have precise predictions on what's likely to happen. But more broadly, though, from the oil sands production point of view, we're given a stability in price at close to $90 per barrel, either routing through the Keystone XL pipeline or finding mechanisms of exporting through through the east on shipments. At least it's an environment which is conducive for those operations to continue in production. Well, the operating environment in Russia is most likely going to deteriorate over the next year or two. The geopolitical crisis in Ukraine does not have a clear pathway for resolution. The Kremlin is resolute on their intent to avoid Ukraine marching towards the West through a European Union, an association agreement, or even with an association with NATO. They are intent on undermining the legitimacy of the current administration through fomenting unrest in the East. That most assuredly will lead Western powers and the European Union and the United States to increase the level of sanctions on Russia towards level 3 sanctions. And so the question is, how deep and aggressive are you going to have a tit-for-tat scenario between the Kremlin and Western powers? And given that we're probably headed towards an escalation of sanctions at a level 3 sanctions, what this means is that Western companies operating in Russia will most assuredly be at risk of retaliation from the Kremlin to punitive measures taken by the United States and the European Union. American companies are probably going to be more at risk than other Western companies, but the operating environment is not conducive towards a stable operating, the rules of the game for foreign direct investments. We're not particularly optimistic over the ability to move on a multilateral, let's say, sustainable environmental agenda. This agenda was moving forward, particularly in an environment where energy prices were very high, where growth was robust, and where policymakers had more of an acute economic self-interest in finding alternative sources of energy, particularly in a high energy price environment where some of these alternative sources of energy were economically more feasible. Now, we're not in a very low energy oil price environment, but at least the economics of alternative sources of energy supply becomes a bit more difficult, and we're in an environment where politicians, both in emerging markets and developed markets, are facing domestic economic and political headwinds. And in this environment, it's tough for you to be able to, from an economic self-interest point of view, to advance a sustainability agenda, and in an environment where the capacity to coordinate internationally is diminishing, given a geopolitical decline in the leverage of the United States in foreign policy, and the G7 as a group to coordinate multilaterally, that agenda becomes somewhat adrift. Evidently, we're still going to have progress on some fronts, but we don't see any game-changing improvements in progressing on an environmental and sustainability agenda over the next couple of years.